Good evening. Hopefully everyone can hear me. Um, I've opened up the Q&A box, so if there's anything anyone needs to say, you can put it into the Q&A. So for those who have attended these webinars before, as you know, it's a 30-minute webinar. I'm going to talk about the markets, what stocks I like, what I've been trading, and then of course I'm going to open it up to Q&A, and you can write your questions in, and we can have a look at the charts, and I can answer any of your questions. The session is being recorded, so I will put up the recording next week for everyone else to view as well. So what I'll do is I'll get stuck into the slides. So as we all know, any advice here, of course, is general only. So for those who, I guess, are watching this later on the recording, as you know, we're a small share advisory firm based in Sydney. We combine both technical and fundamental analysis. My main business is on the portfolio management side, but obviously we've got the research, and there's a lot of free content there, and we're often seen in the media as well. I'm going to go through some charts to start with. As you know, for those who have been subscribers for a while, you know I've been bullish for a while now, for at least a year. I still think we're in the early stages of a bull market. You know, we're overweight resources, but I've got a few interesting charts in terms of, you know, just how things have progressed since our last webinar. So firstly, this chart is from gentleman in the US, Jim Paulson, is producing some interesting charts here. What this is looking at is the real money supply in the US and how it correlates to returns on the S&P 500. So as you can imagine, you know, when money supply is increasing, that's positive for the S&P 500. And when it's declining, that's when you get the lower returns, as we could see on the far right-hand side. You know, we're still in that negative territory, but it is clearly troughed and heading back up. So, you know, we're heading back into that positive region for share market returns. Another interesting correlation is the share market S&P 500 compared to US consumer confidence. So, you know, we're looking at the red line in terms of the dots there show when confidence bottoms out and heads back up. As we could see, it's on the way back up, and that corresponds to the blue dots, which are the lows in the S&P 500. So, in terms of that correlation, heading in the right direction, but still further, as we can see, a lot further to run in terms of consumer confidence, and therefore further upside potentially for the S&P 500. I mean, locally, of course, in the last week, we've been talking about Australian CPI. So as we can see with the green line, it looks like it's flatlining. I mean, the trend is still heading lower, but there was the Melbourne Institute inflation gauge also came out. That's the red line. So that is indicating that we are still in that trend as well. So look, let's not get caught up in the noise on the monthly CPI. It is trending lower. One interesting point that's come up recently, if we go back to what's happening in the US, and that's how the Federal Reserve will react to the unemployment rate. So Goldman Sachs and a couple of other investing houses have cited in the past where the unemployment rate has lifted more than 0.5%. That tends to trigger a rate cut. So as we could see, just going back the last couple of years, the unemployment rate in the US, we could see it's bottomed at 3.4%. At the moment, it's sitting at 3.9%. Now, we know the unemployment rate's a lagging indicator, but you know, the focus isn't 100% on inflation. I mean, central banks are talking tough on inflation because they were a bit slow to the party in raising rates, but the unemployment rate is also equally important, and we've seen commentary from the RBA just in the last few days or so, also citing why unemployment locally is important. So I guess the case we're trying to make is, we can talk about rate cuts not happening for another year, but all the data is pointing to the direction that we're likely to get that. We only have to look at the US 10-year yields. They really are starting to fall. So only about 5-6 weeks ago, we had sort of 10-year yields in that sort of 4.7% mark, as we can see on this chart, close to 4.3, not as low as where we started the year. I mean, obviously, everyone got a little bit too excited with factoring in about 6 rate cuts, which were, a little bit, everyone got a little bit ahead of themselves. But if we remember back to the chart I showed 3 months ago, the correlation between the market and interest rates has broken down. In other words, the market isn't going up because we're expecting lower rates. The market's going up for other reasons. But lower rates, obviously, as long as we don't have a recession, is going to be a positive for share markets. And in terms of recession, of course, latest US ISM PMI. So I've spoken before about the ISM PMI being a very reliable indicator of economic activity. And as we could see on the right-hand side, anything above 50 is an expansion. So we could see that that's, again, just clearly troughed and heading back up. So we don't want the PMI to be really high. History has shown that the best stock market returns occur when it comes off a lower base and is heading back up, not when it's already high and is likely to head lower. So let's just touch on a few things. Obviously, we've been positive gold, got that breakout finally earlier this year. We could see that clearly. It's consolidating in the short term, but I think that's all it is. It's just a consolidation. Breaking out of such a multi-year sideways consolidation should lead you to a much bigger move than what we've seen. We've still got central bank buying. And of course, from here, in my opinion, rates can only go lower, which will be a positive for gold. And the US dollar's starting to come back again. So again, a positive for gold. Oil, I suppose in some respects, not doing what I thought it would do. Sort of end of last year, I was positive on oil. It did run for a few months, but it's come back to where it was at the start of the year. So look, we could see that it is trading in a narrow range. I still believe that longer term there's upside in oil. I think supply coming from non-OPEC countries is in decline. There has been an underinvestment in oil. So there are supply problems. Demand will hold up. There has been a lot of focus on demand, but I think there will be supply issues and we'll see oil back at just under $100 again. Copper, so copper's made that move that was saying it would at the end of last year. Everyone's talking about it now. So of course, as we could see on this weekly chart, it's gone up in a bit of a straight line there at the end of April, early May. So naturally it's cooling off. That's to be expected. You'd be looking for opportunities. We've had a nice trade in Sandfire for our clients. I'm out of Sandfire at the moment, but looking to re-enter. So there's more to go, but obviously a bit of froth in the short term. And finally, uranium, still quite bullish on this. I mean, I don't have a chart of the spot price. The spot price isn't really a great gauge for where uranium's going. You need to look at contract prices, but we can have a look at Paladin as the biggest uranium stock on the board. So when we're looking at that break above $1, which is now $10 because of the consolidation, that's that heavy blue line at the bottom. So that's the start of a big move. We're hitting the first resistance level and easing back. And once we get going again, I think the next resistance level is up sort of around $21 to $23. I know these uranium stocks from their peak about a month ago are off about 20%. As we can see on this monthly chart, it's just a blip. There's still a lot further to run. And if we look at the daily chart of Paladin, I mean that doesn't look like there's any problems at all. You've just got these pullbacks along the way. That's where we are now. So I'd be looking for it to head higher again pretty soon. So in terms of the Aussie market, still looking good. Breakout above 7,600, heading in the right direction. Just consolidating here in the short term, but we've still got that target above 8,000 for this year that I spoke about a year ago. Just in terms of some opportunities, just quickly. Obviously, I've spoken a lot about resources, so let's talk about a few things outside of resources. The banks. So in the Dynamic Investor Report last couple of weeks, we've looked at ANZ and NAB. I've been a buyer of NAB for my clients recently, and obviously we're positive the banks at the start of the year. So I know that's despite what all the analysts are saying, but everyone's factoring in, I guess, slow growth, factoring in no rate rises. If anything, markets were pricing in factoring in no rate cuts, but if anything, markets were factoring in a rate rise the other day. So that is why the banks have taken a bit of a breather here. So as we start to go back to factoring in rate cuts again and an economy that isn't going to move into recession, they'll just head higher and continue to confound the analysts. And the same is true of JB Hi-Fi. So again, retail stocks, everyone's worried about what rates will do and so on. That is why it's come back from sort of $65 to about $56. Obviously, a couple of dollars there to do with a recent update from the company. But we had this in the Dynamic Investor, I think it was 2 weeks ago, a week or two ago, bouncing off support, starting to get moving. So this is another one I like that I've got for clients. And then finally, a stock. Look, it's not been in the Dynamic Investor Report recently, but we've spoken about it at the end of last year. ResMed, looking really good. When it rallied up to that diagonal blue line, sort of in the 33s, I've taken the opportunity to sell out of that, but I'm looking to get back in. So as we could see, very nice support at $30. I'll have to throw this one in the Dynamic Investor next week, but look, that's the level where I'd be expecting to get back in. So looking like longer term we could still do really well, but that's what I'd be targeting if you're not in ResMed already. All right, well, that's pretty much it for the slides. I think that's all I had. Oh, look, there was just another one, of course. If you need any extra help, of course, and you qualify, let me know for a portfolio account. But what I'll do is I'll move over to the charts, and we'll get some Q&A happening. Okay, so we'll start looking at some charts. Three questions into the Q&A. And we can answer those. There's another 15 minutes to go. So, alrighty. So the first one, we've got a couple of stocks there. So Gold Road, as I mentioned, I'm still quite positive on gold. So, if we have a look at this one, look, it's pretty range bound, isn't it? So. It hasn't really participated as well as the other gold stocks. The other gold stocks are generally higher from where they started the year. This one isn't, but it looks like it's starting to get moving. Just on this daily chart, weekly chart, we could see it's quite messy, unfortunately. Linus, it looks like it has bottomed out. So you've got this sort of situation here where it sort of broke support, but then ripped back above it. Part of this chart is pretty messy as well. We've got a bit of a resistance line there that will move back to the daily. it's sort of bounced above, finding support. So to me, it looks like odds are it wants to head higher. The next question's on the lithium market. Look, I think that market will recover, but it looks like the start date for that's just getting pushed out further and further. It is, supply is still quite a bit of supply. Demand is waning. We have seen the lithium price pretty much bottom out. It's just not going up yet. I guess my advice for that sector is if you're sticking with stocks like LTM, PLS, IGO, anything that's making money, they'll be the ones that move first. Those that are not profitable, you'll be in a lot of trouble. Zip. So obviously, fantastic run here. This is probably the reversal here. You've got this sort of outside day, another outside day, struggling to get going before falling again. It just looks like the risk for this one is to the downside. So yeah, not looking to rush into that one. CSL, I think, starting to look very interesting. So we've got, longer term, you've got this sort of sideways consolidation. It's sort of bounced off the lower end, heading back to the top end. And in shorter term, it looks like we've almost got this sort of inverse head and shoulders pattern, where today might have been actually the little breakout. So I think the risk for CSL is to the upside. Question on Novonix. So I don't know much about the company, but again, I think if it's a loss-making lithium miner, it's going to struggle. So we've still got that downtrend, unfortunately. And also IGO was the question there, just base building at the moment. But again, once the lithium market gets going, this will be the type of stock that I think will head higher first, not the ones that are losing money. Brain chip, I haven't followed it in terms of what they've been up to in the past couple of years. So, just going off the chart at the moment, you've got clearly this massive volume here on the way up, pulling back on lower volume, but the problem is it's pulled back quite a bit. So not a great sign. I think you just have to look for another big volume move to get your entry point. So that's just from a charting perspective. FMG, it's obviously one I've sort of liked in the past. I still like it here. Obviously, it's come back quite a bit in the past few days. I think talk of China trying to curb the rising iron ore price puts a bit of short-term pressure on the iron ore price. But they've done this a number of times before. They try to down talk the iron ore price, but it only really has a short-term effect. There's not much they can do about it. Doesn't look like there's evidence of stockpiling on Chinese ports. So still quite positive on it. It's back at support, this $24 region, 23 to 24. That's the big support zone. So you'd be looking for a bounce from here. Woodside, look pretty disappointing for an oil stock. I think there's a lot of concerns over their ESG stance at the moment. It looks like it is trying to base here. I'm just looking at this sort of big move up in a quick amount of time and then the slow pullback, but not great that it's back near that low. If we have a look at the weekly chart, possibly there's also a bit of support here, and we're seeing it bounce out of an oversold position on the weekly chart, which we haven't seen since 2020. So, one to keep an eye on, but just not giving you the upside momentum at the moment. Syra, this is daily chart, still just sort of flat on the canvas. Every time it tries to rally, it's it's back down. So at the moment, there's nothing here that looks appealing. That could all change tomorrow, of course, but at the moment, unfortunately, nothing that looks too crash hot with that one. Eagers, yeah, obviously the gap down. That'll probably just base build for a while, unfortunately. So just sort of, I think, just dead money for a few months until that does anything. BHP for the short to medium term. Look, longer term upside. I think we're still at the start of a commodity bull market. Yeah, a lot of copper exposure, which is great. I think iron ore will bounce back. The Chinese economy is pretty much coming off its lows. It's not really, I suppose, in some ways, not coming off its lows fast enough. But I think the risk for that is to the upside. We're already seeing movements in the Chinese stock market, probably front running what the economy will do. But so longer term upside, short term, it's obviously bounced off the lower end of the range. All a bit sort of price action was really muddied here because of that Anglo-American takeover attempt. But yeah, look, consolidating back here, but generally at the lower end of the range, I'd expect to move at least back up to 50. Fisher and Paykel, yeah, it's done really well. I've still got some old lines here from a previous analysis, but yeah, just broken through all these levels. Obviously gone up quite vertically in the short term, so you'd expect a bit of an easing off. But as we could see on the weekly chart, if it gets towards $30, you're going to get a lot of resistance. So I'd be trying to see if we could squeeze closer to a $30 level out of that. Goodman Group, still just trending quite nicely. That's the weekly chart. If we go to the daily chart, it's had these nice little sort of consolidation and breakouts along the way, even just here, little breakout a couple of days ago. So really nothing wrong with the way that's trading. Getting into data centers, I think, is obviously a positive. That I think that narrative helps the share price. We've seen NextDC do well. I don't think it's sort of bubble territory where everyone's talking about the same thing and getting overly excited just yet. So yeah, Goodman Group to me still looks like a nice hold. Okay, CSR under takeover, so not really much we can add to that, unfortunately. I mean, the risk is that these things fall through. So generally, I'd take the money on this and move into something else. If you're looking for the same sector, you can't go past James Hardie. I think that looks really good. Helios, I had that in the dynamic investor this week, actually. So it looks like it is bottoming out. So you've got that resistance line here. Just need to see it, maybe at least $1.40. Just needs to get out of that range. But there's been a few touches of that level. So now that we've had, looks like sort of 5 touches of this level, it makes it a very clear level. So we know a break above that is something that you can trade. Beach, I think Beach has good prospects longer term. Again, I'm quite positive on oil and gas. The share price has been a bit all over the place. If we maybe it's better to look at a weekly chart. So it's still just sort of like Santos, another gas stock, just sideways, going nowhere, frustrating everyone. I mean, essentially, you could look for a break above this sort of level, call it $1.90, and then it would, you could put on $1 from there. At the moment, it's just not doing anything for you. But I think the longer term prospects are good. Okay, Weebit Nano, yeah, look, that doesn't look great. That's the weekly chart. That's the daily. Just not seeing anything positive about that, unfortunately. Charter Hall. Look, I think this is another sector that looks interesting. Property, of course. Again, bit subdued recently due to concerns that we weren't going to get rate cuts, maybe even a rate rise. But as that expectation shifts more towards, okay, it's pretty clear we're going to get rate cuts, there won't be rate rises, then these will head back up. So look, trading well. It looks like it's going to head higher. I've got no problems with the way that one's trading. St. Barbara, so gold stock. I mean, potentially you've got this sort of flag. It's a bit messy though. But in some ways, not too, in terms of the last sort of several weeks, not too dissimilar to the other gold stocks, just taking a bit of a breather and possibly getting ready for another move higher. Okay, Drone Shield. Yeah, obviously doing well. Massive volume. We can see the volume on the right-hand side. These things, they're hard to get hold of. I mean, just looking at sort of quite unconventional in some respects to the way it's traded here, you get these big moves up, massive reversal on the way down where it looks like it's all over, and then it just continues higher. Then again, you got the sort of gap up, gap back down, leaving this island reversal that's quite a negative, but it's managed to find support and continue higher again. So, a little bit unconventional in the way it's trading. Vertical movement here with a bit of an outside day. So you'd think that odds are that it would pull back again, but maybe it does something like what it's done here, where it sort of comes back and then sort of rounds out for a bit, and then starts to head higher again. But yeah, obviously quite difficult to get hold of these ones. I mean, if you're looking at a buy point, you could say, well, when it broke 40 cents, that was the buy, but at any other time, I don't think it was sort of massively clear as to what that one would do. Okay, we've got Macquarie Group. So look, I really like this one. I've been a buyer of this one throughout the year for clients. I mean, if we just look at some lines here from a previous analysis, but yeah, look, we've got that consolidation, the break above that level 180, the retest, and now it's on the way back up. So it'll get back to the old high, I think, and then consolidate again, and then we've got much further upside. And Macquarie Telecom as well. So again, just this is the weekly chart. Just a great trending stock. Pull back here where it's sort of rounded out, and now it's just sort of getting back into that uptrend. This is the weekly. Looking at the daily, okay, it's a bit messier, but look, just doing all the right things. I can even see good volumes at the right time. So doing all the right things. Okay, so look, that's the half hour, short and sweet. So thanks for attending the webinar. I'll put up the recording next week, and we'll do this again in about 3 months' time. Have a good evening.